If I told you the single best performing asset of 2025 wasn't a semiconductor stock, it wasn't a cryptocurrency, and it wasn't even gold, would you believe me? We are standing in the first weeks of January 2026. And as we look back at the year of the silver flame, the financial media is desperately trying to close the book. They are telling you the story is over. They say the run from $28 to $84 was a speculative bubble. They say the current pullback to $70 is the end. They want you to believe that the poor man's gold is going back to sleep. They are wrong. You think the silver squeeze of 2025 was a mania. The data in this file suggests it was something far more dangerous, a physical correction of a 300-year-old error. While the retail crowd chases the next AI software IPO, I have been tracking the flow of physical metal. The sovereign wealth funds in the Middle East and South Asia have quietly stopped playing the paper game. In late 2025, they did something the COMEX wasn't designed to handle. They stopped rolling their contracts, and they demanded the bars. To understand why silver exploded in 2025, we have to go back to a crime scene from 1717. The perpetrator was a man you know, Sir Isaac Newton. Before he was the master of physics, he was the master of the Royal Mint. And when he set the gold standard for Great Britain, he made a calculation error that haunts us to this day. He fixed the price ratio between gold and silver at roughly 15.5 to 1. But the rest of the world, specifically the wealthy East, valued silver higher. This created an arbitrage that drained Britain's silver and accidentally pushed the West onto a gold standard. But Newton broke something fundamental. He broke the link between price and geology. Let's look at the physics. If you dig up the entire Earth's crust, for every single ounce of gold you find, you will find roughly 19 ounces of silver. 19 to 1. That is nature's exchange rate. That is the physical truth. For thousands of years, from Rome to the Ming Dynasty, the price reflected this. But for the last century, we have allowed paper derivatives to distort reality. In 2024, the market was trading silver at 85 to 1. Think about that. The market was valuing silver 4 times lower than its geological scarcity. That wasn't a market price. That was a suppression, a beach ball held underwater. And in 2025, the rubber band finally snapped. Now, the skeptics, and there are many, will tell you, it's a commodity. If the price is up 200%, the miners will just mine more. Supply will flood the market, and the price will crash. This is the single biggest misconception in the silver market. It is called the byproduct trap. I want you to imagine you are the CEO of a massive copper mining conglomerate in Chile. You produce millions of tons of copper. It is your main course. It pays your shareholders. Silver? Silver is just a geological accident that happens to be in the same dirt. It is the parsley on the plate. Approximately 70% of the world's silver comes from these base metal mines: copper, lead, and zinc. Here is the problem. Even with silver at $70, that copper CEO is not going to spend $5 billion to build a new mine just to get a little more parsley. He chases the copper price, not the silver price. This creates a terrifying economic phenomenon called supply inelasticity. In 2025, demand went vertical, but supply, it stayed flat. In fact, it dropped. Mexican production fell 4% due to lower ore grades. The market screamed for more metal, but the miners, they literally couldn't hear it. So we have a supply that cannot grow. Now let's look at the demand that cannot stop. I call this the silicon vampire. In the 20th century, silver was a monetary metal. In 2026, silver is a strategic energy metal. It is the most conductive element on the periodic table. If you want to move electrons efficiently, you need silver. 2 things happened in 2025 that the general public missed. First, the solar revolution changed gears. The industry shifted from PERC cells to TOPCon and HJT cells. You don't need to know the engineering, you just need to know the consumption. These new cells drink silver. They use 50 to 80% more silver paste per watt than the old technology. Second, AI hardware. Those massive data centers being built by Microsoft and Google, they are heat-generating monsters. To manage that power and heat, they require connectors and solders with the highest possible thermal and electrical conductivity. That means silver. This isn't investment demand. This is survival demand. Samsung, Apple, Tesla, They don't buy silver to hedge inflation. They buy it because without it, their products don't work. In October 2025, the lease rates for silver, the cost to borrow the metal in London, spiked to 39%. That is a number you only see when the vaults are empty. The industrial giants realized the cupboard was bare, and they panic bought everything that wasn't bolted down. We saw the LBMA inventories drop 10% in a single month. That wasn't selling, that was a run on the bank. But instead of cash, they were withdrawing the periodic table. The buffer is gone. The just-in-time supply chain has become not in time. If you are an industrial buyer today, you aren't asking, how much is it? You are asking, do you have any? So, we have the evidence, a geological error correcting itself, a supply chain that is paralyzed, and a demand curve driven by the AI revolution. But you are here for the playbook. What do we do in 2026 with silver at $70? The easy money has been made. Buying at $28 was genius. Buying at $70 requires discipline. We are going to use the gold-silver ratio as our only compass this year. Forget the dollar price. Watch the ratio. Here is the playbook for the smart money investor. Scenario A, the relapse. If volatility returns and the paper markets manage to push the ratio back above 80, meaning silver gets cheap relative to gold, you accumulate. You buy with both hands. That is the market offering you a discount on physical reality. That is a gift. Scenario B, the mania. If the ratio crashes down to 30 or 20, this has happened before. It happened in 1980 with the Hunt brothers. It happened in 2011. If we see 30 to 1, that is mania. That is when your taxi driver starts talking about silver. In that moment, you do the hardest thing an investor can do. You sell. You exit. You trade your volatile silver for stable gold or income-producing assets. The 2025 squeeze proved one thing. In a digital world, physical atoms still dictate the price. The smart money isn't betting on a price. They are betting on a shortage. The question for 2026 isn't how high will it go. The question is, when the industrial giants come for the rest of the supply, can you get any? This is the smart money wisdoms. The future belongs to the owners.